In 1931, the Homeowners Loan Corporation created a map. Not a map of geography or terrain, but a map of risk. Federal officials, armed with clipboards and racial ideology, walked through American neighborhoods. They drew red lines around districts they deemed dangerous. Those lines weren't drawn because of crime rates or structural integrity. They were drawn because of the people who lived there. Black neighborhoods, immigrant communities, working-class districts, all marked in red. The message was clear: do not lend here, do not invest here, do not allow wealth to accumulate here. 90 years later, those lines are still there. Not in ink anymore, but in algorithms, in lending decisions, in home values, in zip codes. This is the story of how a 1930s bureaucratic decision still determines whether you can buy a home in America today. Let's start with two hypothetical buyers. Both earn the same income. Both have identical credit scores. Both are looking to purchase a home in the same metropolitan area. But one lives in a zip code that was redlined in 1931. The other does not. What happens next reveals something ugly about American finance. The system that was supposed to be fixed decades ago is still working, just with a different name. The first buyer walks into a bank in a neighborhood that was never redlined. The lending officer reviews the application. Everything checks out. The neighborhood has appreciated steadily for 3 generations. Schools are rated highly. The local business district is thriving. Banks compete to lend money here. The buyer is offered a mortgage at a favorable rate, 3.5% with minimal fees. The loan is approved within 2 weeks. The second buyer, with identical finances, walks into a bank in a neighborhood that was colored red in 1931. The lending officer pulls up the file. Same income, same credit score, same debt-to-income ratio. But the zip code is flagged. Automatically. The algorithm has learned from decades of data that this neighborhood is higher risk. The data itself is the problem. The data was poisoned from the start. This buyer is offered a mortgage at 5.2%. That's 1.7 percentage points higher. Over 30 years, on a $300,000 loan, that difference costs an additional $130,000. The same person, the same finances, the same ability to repay, but a different price tag based solely on geography. But the zip code itself is not the risk. The zip code is a proxy. It's a legal way to encode what redlining did illegally. When the federal government drew those red lines in the 1930s, it didn't just affect lending in that moment. It created a self-fulfilling prophecy. Banks refused to lend in redline neighborhoods. Property owners couldn't sell or refinance. Homes deteriorated from neglect. Families couldn't build wealth through homeownership. Schools were underfunded because property taxes, the backbone of school funding in America, declined. Businesses moved out. Investment dried up. The neighborhood actually became what the government had predicted it would be, but only because the government had made investment illegal. By the 1960s, when redlining was finally officially banned, the damage was structural. A neighborhood that had been denied capital for 3 decades doesn't recover in a year, or 2, or 5. By the time redlining became illegal, the wealth gap between redlined and non-redlined neighborhoods had widened into a chasm. Today, we have better data than we did in 1931. We have satellite imagery. We have crime statistics. We have income information. We have property tax records. We have everything except permission to use zip code as a direct variable in mortgage lending. So instead, lenders use what they call alternative data. They use the zip code itself as a proxy for risk. Or they use neighborhood characteristics that are statistically correlated with redlined areas. They use school ratings, which are funded by property taxes, which are lower in historically redlined areas. They use rates of homeownership, which are lower in redlined areas because families were denied mortgages. They use unemployment rates, which are higher in areas that were starved of business investment. Each of these variables seems neutral on the surface, objective, data-driven, but they're all downstream of redlining. They're all measuring the impact of a policy that was explicitly racial, now disguised as objective economic analysis. The Federal Reserve released a study in 2021. Researchers traced modern mortgage approval rates back to redlining maps from the 1930s. They found that neighborhoods colored red on those maps had approval rates 25% lower than neighborhoods that were never redlined, even after controlling for current income, credit score, and property characteristics. The color on a map drawn 90 years ago still determines whether a bank will lend you money today. Home values follow the same pattern. A house in a historically redlined zip code appreciates more slowly than an identical house in a non-redlined zip code. The median home in a redlined neighborhood appreciates at roughly half the rate of a home in a non-redlined neighborhood, according to research from the Brookings Institution. This means that even when families do get mortgages in redlined areas, they build wealth at half the speed. The house doesn't appreciate as much. The down payment on the next house is smaller. The next house is in a neighborhood that appreciates even slower. Generational wealth doesn't compound, it stagnates. So the zip code tax isn't really a tax in the traditional sense. It's an invisible transfer. Money that would have accumulated as home equity in a redline neighborhood instead accumulates in the pockets of lenders as higher interest payments. Money that would have been passed down to the next generation instead goes to a bank. The mechanisms are subtle. Appraisers, for example, are supposed to evaluate a property based on comparable sales. But in neighborhoods with less recent sales activity, which redline neighborhoods have, because fewer people could get mortgages, appraisers have to reach further for comps. They might compare a house in a redline neighborhood to a house in an adjacent neighborhood with lower values. The appraisal comes in low. The buyer can't get the loan amount they expected. They have to bring more cash to closing, or walk away. Or they take a lower appraisal as given and accept it, which affects their equity and their ability to refinance later. Insurance companies also use zip codes. A homeowner's insurance policy in a redline zip code costs more than an identical policy in a non-redline zip code. Not because the risk is higher. Research shows that property risk is not correlated with historical redlining status. But because insurers have learned to price by zip code, just like lenders have, the zip code becomes a sorting mechanism for risk, even when it shouldn't be. All of this is legal. There's no law that says lenders can't use zip codes. There's no law that says insurers can't. The Fair Housing Act of 1968 banned explicit discrimination based on race, but it didn't ban discrimination based on geography, especially when that geography is a direct result of racial discrimination from decades earlier. The law essentially said you can't discriminate based on race, but you can discriminate based on the consequences of historical racial discrimination. Which is to say, the law has a loophole the size of a city. Some lenders have begun to change their practices. They recognize the problem, at least in principle. They've started to exclude zip code from their algorithms, or to add additional variables that aren't correlated with redlining. A few have committed to lending in historically redlined neighborhoods at rates comparable to their overall portfolio average. These are steps in the right direction, but they're voluntary steps. The system doesn't require them. The market doesn't penalize lenders for using zip codes, even though zip codes are a proxy for historical discrimination. Why doesn't the market fix this on its own? Because lending actually works very well for lenders in the current system. When a lender charges 200 basis points more to a borrower in a redline zip code, they don't take more risk. The risk is priced in. They just make more money. The system is perfectly efficient at transferring wealth from borrowers in redline neighborhoods to lenders and their shareholders. Fix could come from regulation. The Consumer Financial Protection Bureau has the power to restrict the use of zip code in lending. Congress could amend the Fair Housing Act to explicitly prohibit discrimination based on geography that correlates with historical redlining. The Federal Reserve could require banks to monitor lending disparities by zip code and justify any differences. States could pass their own laws. None of these things have happened except in isolated cases. The political will is absent. The issue doesn't poll well. It's too abstract, too historical, too much about invisible systems. People don't connect their 5.2% mortgage rate to a map drawn in 1931. But the math doesn't care about what people understand. The zip code tax is real. It's built into the price of homes. It's built into the monthly mortgage payments of millions of Americans. It's built into the wealth gap that hasn't closed in 80 years, despite fair housing laws and civil rights legislation. The gap closes slowly. Sometimes stops closing entirely. Sometimes reverses. Because every month, every day, every mortgage application processed, the zip code tax is collected. The irony is that this system is defended with the language of fairness. Lenders say they're just being objective, using data, managing risk. They're not discriminating, they're analyzing.